Aaron Kennedy here today with Evan New. We're doing Tech Teardown for Friday, February 21st. Now, what would you buy with $19 billion? Earlier this week, social juggernaut Facebook announced that it will be acquiring WhatsApp for $19 billion, paying mostly in stock. That's a lot of money, bigger than some companies' entire market caps. What do you think of this deal? Did it shock you? When I heard it, everyone kind of thought it was a punchline.
No, the number, that's just so much money. That really kind of knocked me off my seat. I was like, what, 16 plus the 3 in restricted stock, like $19 billion? I mean, for some perspective, Twitter is valued at just over $20 billion right now. So it's almost like Facebook just spent a Twitter on buying this WhatsApp service. But beyond the price tag, I think that this deal does make a lot of sense strategically. Because while Facebook has really been crushing it on mobile, that's all been about ads and its core newsfeed app, not really around its messenger platform, messaging service that it offers both on mobile and desktop. And I think that that's kind of where Facebook's been lacking, is because Facebook Messenger is it has very different social expectations than something like WhatsApp, which is very much an SMS replacement. Because WhatsApp, on SMS, you expect a response pretty quickly in real time, whereas on Messenger, because it's mostly a desktop thing,
it's not as urgent.
Some people may or may not have it on their phones, so you don't really expect a response. So as far as the social expectation, it's kind of in between SMS and email. So it's like sometimes you get a response right now, sometimes you get it later, and that just shows there's a very key difference in the use cases. And Mark Zuckerberg is very aware of that. He specifically noted on the conference call.
So what else is Facebook getting out of acquiring WhatsApp for that big price tag?
So WhatsApp is now up to 450 million monthly active users, which is kind of insane with how young it is. And it even has a greater percentage of its user base that use it on a daily basis, like greater than Facebook, which is something that they're pretty impressed with. Both companies expect that WhatsApp can get to 1 billion users in the near future, and that's kind of what this whole deal is predicated on, is that they can continue growing and really get to this 1 billion threshold, in which case any internet service that has 1 billion users becomes inherently extremely useful and very valuable. They're even talking about getting to like 2 and 3 billion, but that's obviously further down the line. But I think that more importantly, Facebook gets a lot of international exposure, because WhatsApp is extremely popular in places like Europe, South America, Latin America, Asia, India.
So it's the emerging market story.
Right, whereas in the US, WhatsApp is certainly popular in the US, but it's less important because in the US you have companies like Apple that offer iMessage for free, and Apple was like 45% of smartphone sales last year, and they already have that. And for example, just anecdotally, I looked on my WhatsApp, and like none of the people that I message regularly are on WhatsApp, because most of them just have iPhones. So there's not really any reason to go the extra step and pay an extra nominal fee. So I think that that's part of it too. Well,
so my question is, WhatsApp doesn't really pull in any money, and Facebook is going to need to monetize WhatsApp eventually. So what are they going to do? They're going to have to slap some ads on it, right?
Well, they definitely avoided this question as best they could on the conference call, but they're very...
Did you think that was telling? Do you think they don't really know quite yet how they're going to...
I don't think they know quite yet, but they do know that they are very against advertising, because both Mark Zuckerberg and WhatsApp, both companies don't think that ads are just a good way to monetize a messaging platform. Because it just distracts you, it takes away from the actual what you need to be doing on this service.
Which is messaging, right?
Right. WhatsApp transitioned last summer to a subscription model, and right now it's free for a first year, and then after that it's $1 a year, which is an insanely cheap price point for something that right now SMS, the wireless carriers, they make about $100 billion a year as an industry off SMS revenue, and now WhatsApp comes in here and they're like $1 a year. Like, it's kind of crazy. But that's kind of also the appeal here, is that's the real disruptive potential, is that they can come in here and offer the service at such a low price point. But and right now, certainly not everyone has transitioned to the subscriptions. So I've seen some numbers like maybe they're doing about 20 million in revenue right now, which is almost nothing compared to in the Facebook scheme of things. But eventually, they will want to monetize this, and they did say that eventually we will. But after we get to this 1 billion plus user threshold, that's when we're actually going to start thinking about how to monetize it.
So when Facebook acquired Instagram in 2012. They basically said, Instagram, you can pretty much operate independently. And they're claiming that's what they're going to do with WhatsApp as well. What do you think about this strategy by Facebook?
I think it's interesting because, like you said, it shows that Facebook is really willing to operate 3 very distinct, separate platforms. And Instagram, they did put ads in that, but WhatsApp, they're going to take a little bit different. So I think that also shows that they're willing to kind of use different approaches with all of these services, because, for example, WhatsApp's subscription model is directly in contrast to Facebook's model, because Facebook is very adamantly and aggressively maintained that it will never charge a subscription fee or some type of monthly thing, whereas that's exactly what WhatsApp is more or less doing. But I think that WhatsApp has also been kind of like really resistant to the whole idea of becoming this platform like some of its competitors. Like WeChat, they want to be this messaging platform for like chatting and shopping and games and even banking, like all these sorts of things. And they have ads. Whereas WhatsApp is like, we don't want to do any of that. We think that stuff's kind of annoying when like you keep getting these, you know, it's annoying to have this company be like, hey,
yeah,
play this game, you know. And you know, I think that's also kind of the right approach. But at the same time, they're quietly doing some small platform moves that, you know, so they integrate with, you know, certain websites to, you know, share links over WhatsApp. So they do have some of these kind of underlying platform strategies, but they're not being nearly as aggressive. But I think that's really the right call because that, you know, that's better for the users ultimately.
So what did you think of WhatsApp's purchase price? Not just that it was obviously a really big number, but about 15 billion of it is being paid in stock or restricted units from Facebook. What did you think of Facebook's move there? Well,
there's a couple things to read into this. Kind of more generally speaking, when companies, you know, how companies structure these deals in terms of what they're using as currency, there is some information in there because, you know, if a company pays in all cash, you view that as this really vote of confidence that they're very confident this deal will work out.
Does Facebook even have enough cash? I mean, Facebook isn't like Apple.
Right, they don't have. Right now they have about 11 billion.
So they couldn't have done this deal with just cash anyway.
Right, so it's not like they even have enough to go to this 16, 19 billion number without getting into stock. But at the same time, right now the stock is at all-time highs. So it makes some sense to also use the stock as currency in a deal like this. But you know, going forward, you know, if a company were to pay in all cash, they get to capture all future value creation that comes from this deal. Whereas if you pay out based in stock to, you know, some degree, you're basically sharing that risk and reward of the future of this deal with whoever you're buying this company from. And you know, that can be for better or for worse, but the point is that you're kind of sharing, you know, the future of this with, and with this deal is really, the bulk of it is in stock. So I think that there is, you know, some possibility that Facebook knows this is a hefty price to pay. But you know, they're kind of like trying to mitigate the risk by sharing it with, you know, the owners of WhatsApp.
Well, and again, the owners of WhatsApp are still getting $4 billion.
Oh yeah, I mean,
cash.
still pretty good amount of cash for a company that has 50 employees.
I was gonna say, like, they're kind of like sharing the risk, but not really because they just got $4 billion in cash.
I think they'll be okay.
Yeah. So shares of BlackBerry, which I thought this was a really interesting story. Shares of BlackBerry actually rallied on the news of Facebook's acquisition of WhatsApp, because right now one of the bull cases for BlackBerry is supposedly their BBM messaging service having a lot of value and keeping the company afloat. What? Like, it's BlackBerry. They're not going to stay afloat just because people really like their messaging.
Yeah, I've never liked that whole story and bought into the whole idea of BBM being.
That just doesn't have enough legs. Yeah.
I mean, CEO John Chen has outlined 4 really core parts of BlackBerry's turnaround story: is enterprise, embedded devices, and messaging. And they did open up BBM for cross-platform support, iOS and Android last year. Got about 40 million registered new users. You know, total right now they're at about 80 million, which, you know, is pretty good for where BBM has been historically. But there's this tendency to look at this WhatsApp deal and say, oh, Facebook is paying about $42 per user, and then apply that as like some comparable analysis to BlackBerry, and then you get to this crazy like $3.4 billion number or valuation for BBM. But
so do you think like Facebook's going to buy a BBM now?
No, I mean like Facebook itself is only valued at like $30 some odd per user. So I mean, I think that there's some insight into looking at this valuation per user, but it's very limited. Like, don't overread it.
Right.
And especially with these types of social networks, I mean, obviously network effects come into play, and then the more users you have, the more valuable each user becomes. So, I mean, WhatsApp is over 5 times as big as BBM, so you can't really just apply the same number and just expect everything.
So you don't think the bull case for BlackBerry depends on BBM?
I've never really understood the whole BBM bull case. I mean, I know that they're trying to really kind of open it up and create an advertising platform out of it, kind of like Twitter with like these channels. But I don't see that really being a very strong value proposition with as much competition as there is. I mean, in fairness, I will say that I think that the WhatsApp deal does show that there is a lot of value in these messaging services, more so than probably people have ever thought before. And I mean, maybe BlackBerry could sell, you know, some of the underlying BBM technology to some of these bigger players. That might be a better way to kind of get something back out of this segment that they have. But I don't think it's a really great story in the long term of BBM.
All right. In other social network news, Earlier this week, LinkedIn said it would be opening its publishing platform to all members. To date, only selected influencers could publish. What's driving this move?
I think LinkedIn kind of wants to be a little bit like Facebook right here. I mean, they've been focusing really heavily on content recently with this influencer program, creating this feed, buying polls, all these various things that can kind of help drive this marketing solutions business, as well as just kind of building user engagement and kind of limiting this publishing platform to these selected influencers has always been kind of like an artificial limit, like why hold it back when you have this vast knowledge base among your collective users of all this experience and knowledge that's very useful for business applications and professional settings. And I think LinkedIn is realizing that, like, why don't we do this? Like, we can easily have this, all this really valuable content that can appeal to professionals, and people want to express themselves, so they might as well just go ahead and do it. And not only does it drive ad revenue, but yeah, just really just builds platform engagement.
So last month we saw numbers that showed that LinkedIn's monthly unique visitors are actually stalling out the number. Is that something to be concerned about?
A little bit. So last quarter they said they had about 139 million unique visitors, which was down from 142 million a year prior. Page views were down from 11.6 billion to 10.6 billion. So these numbers aren't really good. I mean, they're definitely pulling back a little bit. Those don't include mobile, which a lot of usage is shifting to mobile. About 40% of users are on mobile now, so that's worth pointing out. But at the same time, like, I think that LinkedIn is very different from Facebook and Twitter in terms of how much it relies on engagement, because Facebook and Twitter are all about ads, so you need to be constantly looking at the site and engage with the site so they can sell ads and display them to you. Whereas LinkedIn, about 3/4 of its revenue is based on talent solutions and premium subscriptions, so, enterprise recruiters that are just trying to go through their database and find the right talent. And that doesn't really have as high of a bar with engagement as something like an ad-driven business. I mean, you just need your members to be keeping their resume up to date and engaging to a certain extent, but not nearly as high as
Facebook or Twitter,
like having to show ads constantly. So I mean, I think that, not to say that engagement is not important for LinkedIn, but that it's less important to it than its competitors.
So Facebook has been concerned lately with the quality of the content that's posted on their newsfeed. They don't like the memes and stuff like that, and they've been tweaking their algorithm to try to adjust the content accordingly. So I feel like LinkedIn, does it concern you that LinkedIn is doing this? Because quality has to be a much higher concern for LinkedIn, given that it's a professional site.
Oh, sure. I mean, you're definitely right, Aaron. I mean, like, Facebook has been kind of like pushing this quality articles and, really trying to move away from, the types of low quality content that generally just goes viral, like GIFs and memes and.
Well, if you go to LinkedIn and you go to your influencers or whatever, if there's just a bunch of memes, would you take, would you take it seriously?
Well, I think that maybe that's why they waited to open up in the first place. Maybe that's something they're worried about. But then I think that it's kind of one of those things that will be self-policing, because if you're on LinkedIn and and
you're posting dumb stuff,
like, you're not posting like pictures of you at the bar getting wasted, or like your cat, doing whatever.
I would totally post pictures of my cat on LinkedIn.
Well, that's just you, though.
Yeah, I'm just saying, totally would.
But I think for the most part, people are very careful about managing their online identities in this day and age, especially when it comes to professional reputations and professional network like LinkedIn. So, I mean, if someone is dumb enough to go out and post like these ridiculous things on LinkedIn, they have much more to lose personally in their own career than LinkedIn does on their business. So
LinkedIn's just counting on, like your own sense of self-preservation.
Probably. I mean, maybe we'll hear more later, but I would imagine that it will just take care of itself.
All right. It's been an interesting ride recently for the iEverything maker. Most street analysts are constantly changing their ratings on Apple. However, one analyst has been bullish on the tech giant for over a decade. But now he's changing his tune.
So Barclays analyst Ben Reitz, he's had an overweight rating on Apple for about 10 years. Recently downgraded to hold, which is pretty important since 10 years. I mean, that's a long time to be bullish.
It's clearly been.
I mean, I think the main point that he's getting at is that Apple is still all about the iPhone. I mean, this business still relies very heavily, despite all the talk about new product categories. The iPad is still on the rise.
Yeah, I feel like we've been hearing about an iWatch or an iTV forever.
I mean, the iPhone is just such an enormous business now that it's really hard to imagine it sustaining double-digit unit sales growth going forward. I mean, they sold about 153 million iPhones last calendar year, which was up 13% from 2012. But these are all mid-range and high-end phones, and it's really hard to just see how do they keep getting bigger and bigger and bigger. So it's definitely true that unit growth is going to get harder to come by, especially since Apple will not go into the low end, as we all know. And also I think he's kind of skeptical about some of these new categories that investors are expecting. Most obviously would be iWatch and Apple TV. He doesn't think that those have the game-changing potential that some people might hope, and that they're really kind of positioned as just more ways to sell iPhones.
That's interesting. But he also made a kind of scary analogy. He compared Apple to Microsoft because Microsoft, over the last decade, approximately the last decade, shares have traded flat. Ain't nothing happening for Microsoft stock. So does this concern you? Do you think Apple shareholders are in for a slow decade?
Not necessarily, but I will say that it is kind of hard to see how Apple can really grow its top line in a really big way going forward. I mean, they did about $175 billion in revenue last calendar year, which is kind of insane for a company that basically only sells 10 super profitable products. Like if you look at the Fortune 500, the only companies that have bigger top lines are literally oil companies, Berkshire Hathaway, and Walmart. And those are all completely different businesses here. That being said, Apple has really been aggressively giving money back to shareholders now with dividends and repurchases. So if you look at Microsoft's decade of stagnation from about 2000 to 2010, they actually still did give back a pretty good amount of money to shareholders in the form of dividends. More recently, in the last 10 years, I was just looking at some of these numbers to kind of see the total return difference. And Microsoft over the past 10 years is up about 44%. Part of that is, the rally from Steve Ballmer announcing his retirement, which got people excited. But if you include dividends for total returns, shares are actually up 94%. So I think that, that's a 50% point difference in return just from dividends. So even if Apple can't really grow the business to the same extent that it used to, it doesn't mean it's going to be a bad investment because they're going to be giving back a lot of this in dividends to investors.
So shareholders can at least take comfort in the dividends.
Right. I mean, I think maybe the growth days and capital appreciation days might be, people should lower their expectations for those types of things, but you should increase your expectations with cash return and dividends and income. So.
All right. There's been a lot of discussion this week about the idea of Apple buying Tesla after Elon Musk confirmed that the two companies have had conversations. Why would Apple buy a car company?
They wouldn't. I mean, I think that there's all these people like the idea because people have always compared Tesla to Apple and saying, oh, it's the Apple of the car industry. And I think that there are a lot of similarities in terms of culture, innovation, product strategy, like focusing
premium
on
pricing,
premium positioning. But the reality is that these companies have nothing to do with each other.
Is it because one makes iPhones and the other makes cars? Do you think that's just a little too far apart?
Well, plus there's the whole soundbite from years ago that Steve Jobs dreamt of making in a car, but Steve Jobs dreamt of so much stuff that never happened.
Yeah, and he's also dead. So,
right, and he's not around anymore to make these types of calls. But even he knew better than to get into this market. But I mean, from a financial perspective, this makes even less sense. So I mean,
well, but the thing is though, is Tim Cook did say recently in the Wall Street Journal that they're not afraid of making huge acquisitions.
Right, he did say that.
And Apple has tons of cash.
So he did say that, but I think that he also mentioned that Apple will be willing to pay 10 figures, which is only $9 billion before you get to 10, which maybe that's a arbitrary quote, but I mean the point is that right now Tesla's at $25 billion. Her market cap is $25 billion, and that's a pretty astronomical valuation. I mean, I like it because Tesla and Apple are two of my biggest holdings, so I'm not complaining. But at the same time, it has a lot baked into that price, and that's a really big premium. And before you even talk about any acquisition premium, so if we're talking plus Apple needs to spend $30+ billion to buy this company that has nothing.
I like that we're actually talking about Apple maybe buying Tesla.
Oh no, we're not.
Could even possibly.
No, it can't possibly. But just the idea of it is just ridiculous because I mean, so if they're spending over $30 billion on this idea that they're going to do it, just to put that in perspective, that's more than 4 times as much as Apple has spent on acquisitions over the past 17 years.
Wow.
And
yeah.
It just doesn't make any sense. And Tim Cook's whole thing has always been, we're just not going to, I think his main point was that we're not going to let price be this thing that holds us back alone. If a company is truly the right fit for the long term, for all these longer term strategic reasons, they will go forward with it even if it's a really big number that's beyond kind of their historical range and price points. But again, Tesla makes 0 sense because there's no long-term synergy.
Because where to begin?
They don't have synergies at all. They have nothing in common. I mean, maybe battery stuff. Maybe that's what they were talking about.
The next Tesla is going to be powered by iPhone batteries. Is that what you're saying?
I mean, both Apple and Tesla put a lot of R&D into battery technology, which maybe that's all that Musk was talking with Apple about, is just battery. I don't know. I just don't know why people are really fixated on this whole idea. I think it has a nice narrative.
Is it just kind of one of those
People just want it to be true.
Yeah.
It's not going to be true, though.
All right. That's all for today on Tech Teardown. I'm Erin Kennedy with Evan New, and I want to say a very special thank you to my Aunt Debbie and Uncle Brian for this awesome birthday sweatshirt. Have a great day.